Welcome to The Explainer. Today, we're unpacking a fascinating financial paradox surrounding an absolute behemoth, JPMorgan Chase. We're talking about a mega bank with an astronomical market cap sitting right around $893 billion. But according to the source material we're analyzing today, there is a massive structural shift happening right beneath the surface of this financial giant. And honestly, it's a shift that the broader market might be totally missing right now. Which brings us to the core paradox of today's analysis. Think about it. How is it possible that the absolute flagship of the U.S. banking industry, a bank with unprecedented scale and resources, is actively failing algorithmic quantitative ratings? It sounds completely counterintuitive, right? Why on earth would an $893 billion financial fortress get an F grade in profitability? So take a look at this. Algorithmic quantitative ratings are currently handing JPMorgan an F in profitability and a D+ in growth. That algorithmically lands the stock with a pretty mediocre hold rating. But then you compare that to reality. Over the last 12 months, the bank generated a staggering, record-breaking $58.89 billion in net profit. That's up from just over $49 billion in 2023. So we've got an algorithm literally calling this cash generation ineffective, while the actual ledger shows historic, massive profits. So the crucial question is, why are these models missing the mark so badly? Well, the author of our source text perfectly calls this the trap of the rearview mirror. See, these algorithmic models evaluate profitability by comparing traditional, capital-heavy banking to the broader market, which, as we know, is currently dominated by tech and AI giants, generating massive margins just on software. Plus, these algorithms are strictly measuring a 15-year historical era where banks were forced into really harsh capital austerity. They're essentially completely blind to the future.
Engine 1. The Regulatory Thaw.
Let's rewind a bit. Following the 2008 Great Financial Crisis, laws like Dodd-Frank forced banks to hoard massive amounts of capital. They had to sterilize colossal volumes of liquidity, which artificially capped their profitability. But jump to March 2026. Facing heavy criticism, regulators decided to essentially cut the harsh reserve requirements of the Basel III endgame, and June 18, 2026 was a massive milestone. It marked the end of the key 90-day public discussion period. So even though the official bureaucratic launch won't happen in 2027, the rhetoric has officially shifted from suppression to stimulation, and as you know, the stock market always trades on forward-looking expectations. The author actually uses a fantastic metaphor to describe the result of this timeline: the compressed spring effect. Since the pandemic, the U.S. economy has seen huge nominal GDP growth, obviously heavily driven by inflation. Businesses and consumers have adapted to these new higher price levels. But because of those strict regulatory limits we just talked about, bank lending just couldn't keep up. The real credit portfolios grew significantly slower than the economy itself. Basically, the leverage in the U.S. corporate and private sectors has been artificially compressed. And now that spring is ready to uncoil. This is really all about regulatory arbitrage. By lowering CET1, the core capital regulators force banks to hold, by roughly 4.8%, regulators are allowing JPMorgan to legally unfreeze billions of dollars. Previously, the bank was forced to park this excess capital in safe but sterile assets, like treasury bonds yielding around 4 to 4.5%. Now, they can shift those exact same funds into active lending in the real sector, where interest rates are sitting at a much juicier 7 to 9%. They don't need to raise a single cent of new money. They're just shifting funds internally to capture a massive net interest spread.
Engine 2. The AI Margin Multiplier.
To really understand the impact of AI here, you first have to grasp the sheer scale of JPMorgan's operations: $50 billion. Let that sink in. That is roughly what the bank spends every single year exclusively on payroll, employee compensations, and benefits. And the vast majority of this astronomical expense goes toward back-office operations, routine compliance, and document processing. And this is exactly where generative AI acts like a highly precise scalpel. JPMorgan's massive scale allows it to invest in AI infrastructure that regional competitors literally cannot afford. By implementing specialized language models, they're automating the processing of primary documentation, conducting rapid legal audits, and executing real-time compliance control. Routine tasks that historically took weeks are now being fulfilled in seconds. The author notes that even a highly conservative reduction, just a few percent in that $50 billion expense pool, will organically push net profit upward by billions of dollars. But here's the thing. AI isn't just a cost-cutting tool. It's a completely new way to manage risk. The technology is revolutionizing underwriting by analyzing terabytes of unstructured data in real time, which significantly minimizes the probability of defaults. So when JPMorgan unleashes that compressed spring we talked about and begins an aggressive credit expansion, they can do so without degrading the quality of their assets. They are effectively de-risking their own growth.
Reality check. Stress testing the risks.
Of course, we have to look at the headwinds, and the analysis identifies three primary macroeconomic and geopolitical threats. First up, a hard recession. If the U.S. economy faces a severe downturn, corporate and consumer demand for credit will simply collapse, effectively wiping out the benefits of those new Basel III lending limits. Second, lower net interest income. If inflation drops suddenly and the Fed aggressively cuts rates, the bank's core lending margins could get heavily squeezed before they even have a chance to build up their credit volumes. And finally, geopolitics and energy shocks. Sudden spikes in oil or global conflicts could paralyze capital markets and M&A activity, taking a direct hit on JPMorgan's massive investment banking fees.
However, the author singles out one specific scenario as the absolute most dangerous threat: a new round of inflation. If inflation spikes again, it would force the Federal Reserve into a panicked, aggressive interest rate hike, perhaps by a full percentage point or more than 100 basis points, right from current levels. This could easily trigger a wave of defaults. But that being said, based on the macroeconomic picture in mid-2026, the author believes the probability of this catastrophic scenario remains moderate at best, and the overall balance of risks leans strongly toward stability.
The climax, the double lever effect, and reevaluation target. At the end of the day, it's not just about guessing future profits, it's really about the expansion of the price to earnings, or PE multiplier. Currently, the market is valuing the bank at a modest 14.9 times forward earnings. The author argues this is actually a historical discount, essentially a regulatory fine left over from 2008. But as the market wakes up to this new, de-risked, highly protected, and technologically advanced reality, the author expects a systemic destigmatization of American megabanks, and that could push that multiplier right back toward a fair value of 20x.
Let's do the math on that. If we keep the forward earnings per share absolutely flat at $22.33, but simply expand that multiplier from 14.9x to a historically normal pre-crisis level of 20x, the fair value of the stock jumps from roughly $336 up to $446. That unlocks a long-term upside of over 30% by the end of 2027. And remember, that's driven entirely by a shift in market perception, even before factoring in the organic profit growth from the new loan expansion. Which leaves us with a final, pretty provocative question based on the source's thesis. As the regulatory grip loosens and artificial intelligence fundamentally reshapes the cost structures of these financial giants, have megabanks officially reclaimed their status as the prime generators of market profit? Those algorithms looking in the rearview mirror might say no, but the structural shifts happening right now suggest a completely different future.